Hi everyone and welcome to DIY Finance Guy. I'm your host Sergey Modilevsky, and in today's video we'll discuss the implications of rising variable rates and falling fixed mortgage rates. As you may have heard, the Bank of Canada increased overnight rates for the 7th time this year, which has led to a lot of turmoil for variable mortgage holders. Their payments have increased by up to 70% over the last 6 months. And it's estimated that over 50% of variable rate holders have reached the trigger rate, where their payments no longer cover the interest expense. That would account for over 14% of all mortgages in Canada. But here's the interesting part. While fixed mortgage rates have also increased over the last 7 months, they've recently started to fall. Many banks now offer reduced fixed rates, while most variable rates have climbed to between 5.2% and 5.6%. This means that depending on your down payment and mortgage term, many fixed mortgages are cheaper than variable ones, which is pretty unusual. So why is this happening? Well, it's all related to the inverted yield curve. When the Canada 10-year and 2-year bond yields are inverted, the yield on the 10-year bond is lower than the yield on the 2-year bond. This phenomenon is often seen as a signal of an impending recession, because it indicates that investors are more confident in the short-term economic outlook than the long-term outlook. In the early 1990s, when the Canada 10-year and 2-year bond yields inverted, mortgage rates in Canada also fell. This was because investors were more confident in the short-term economic outlook and were more likely to take on longer-term debt such as mortgages. As a result, lenders were more willing to offer lower rates to attract these borrowers, which led to lower mortgage rates for homeowners. This made it easier for them to afford their monthly payments, and it helped support the housing market during that time. Today, fixed mortgage rates are lower than variable rates because bond market traders and central bankers expect more modest increases before a lot of rate cutting over the next 3 years. The best visual tool for explaining rate expectations uses US market data, which is what we're going to use. For what it's worth, Canada and the United States have correlated movements in CPI, PPI, GDP, and employment, so we expect overnight lending rates to remain within 50 basis points of one another in Canada and the US. The bond market speculates that the US Fed may increase up to half or 50 basis points over the next 2 meetings, but may start cutting rates between September to November. On the other hand, central bankers are more hawkish and forecast that rates will peak another 1% higher in 2023 before cutting rates in 2024 down to 4.15%, which is around today's levels. Over the next few years, from 2024 to 2026, rates are expected to fall to around 2.5%. That's 1.75 points lower than today's levels. In 2026, you'd still have 2 years left in your mortgage term if you're taking a new mortgage today. The biggest benefit of converting from a variable to a fixed rate mortgage today is that fixed rates are lower. It would improve your cash flow and may help you sleep a little easier in the near term. Still, as I mentioned, bond market traders have inverted the yield curve and hold a staunch belief that central bankers will cut aggressively starting in late 2023. As this chart indicates, bond traders have been successful at calling these cuts in the past. In addition to the recent changes in the Canada 10-year and 2-year bond yield, the big 5 banks in Canada have also continued to cut the discount on variable rate mortgages. As of today, the average discount offered by these banks is 60 basis points, less than what was offered in December 2021. This decrease can also signal that the lender is less confident in the economy and is therefore less willing to offer lower interest rates to attract borrowers. This can be a sign of tighter lending conditions, which can make it more difficult for borrowers to qualify for a mortgage and forces more borrowers into alternative lending options at higher rates and fees. Overall, the recent changes in Canada 10-year and 2-year bond yield, combined with the big 5 banks' continued cuts to the discount on variable rate mortgages, suggest that the economy and housing market in Canada may be facing some headwinds in the months ahead. This is playing out as a result of the most consequential monetary tightening cycle in a generation. It's coinciding with the most significant fracture in international relations. At the same time, new economic paradigms appear to be emerging around labor markets, interest rates, emissions, trade, and national defense. 2023 is going to be very choppy for highly indebted Canadians. Spending and house prices will fall further and delinquencies will rise. Rates will remain high for some time in 2023, while the Bank of Canada wrestles down inflation to its 2% target. but the global economy is showing easing in underlying price pressures, and that may lead to lower rates in the latter part of the new year. Last week, 5-year fixed rates dropped 35 points after Canadian bond yields have fallen over 20% from peaks set in late October. In addition, the Bank of Canada's recent policy statement wasn't as hawkish as many expected, which means that they might put pause on rate hikes in the next meeting in January. This was the position expressed by CIBC Chief Economist Benjamin Tal. Even if rates have peaked, the worst may be still to come for the housing market. If we revisit the environment of the early 1990s, the worst bouts of consumer inflation were behind the economy, but housing prices were only starting to fall. The rapidly rising interest rates had created a tightening of financial liquidity that eroded consumer sentiment towards purchasing a home. The deterioration accelerated as more workers were laid off and people grew pessimistic about the future of the job market. Prices fell continuously in some major markets from 1989 to 1996. They fell despite 5-year mortgage rates decreasing precipitously over the 4-year period between 1990 and 1994. In 2023, we're going to see meaningful job loss in the process of taming inflation. These losses may end up exacerbated by the upcoming fourth industrial revolution, a trend of automation and data exchange in manufacturing technologies, including developments in AI, the Internet of Things, and advanced robotics. This revolution is characterized by the increasing use of technology to improve production processes and the integration of physical, digital, and biological worlds. We're witnessing a coincident declining trend among real income, real consumption, industrial production, and the Household Survey of Employment. After an unprecedented tightening cycle, the Bank of Canada has sucked the liquidity from financial markets. That's keeping most buyer demand on the sidelines. On the other hand, sellers are facing increasing pressure, and those forces will be more pronounced over the next 6 months. Inventories will grow in resale properties, and we may see some fireworks in the pre-construction assignment space as more homes are completed and come onto market. I anticipate more pressure on home prices ahead, but I'll be diligently looking for upside catalysts. I think rates have some room to fall, but that'll depend on what CPI, PPI, and employment reports show over the next 60 days. So there you have it. That's the breakdown on rising variable rates and falling fixed mortgage rates. If you have any questions or comments, feel free to leave them in the comments below, and remember to like and subscribe to our channel for more great content on mortgages, real estate, and personal finance. A reminder, this is not financial advice. Do your own diligence to form an opinion on what happens next and allow that to guide your decisions. Thanks for watching, and I'll see you in the next video.